Financial Insights Show with Eric Ludwig and Liam Hanlon. Yeah. The Financial Insights Show, dropping knowledge that'll grow. We got that conversational intelligence. Ludwig and Hanlon giving evidence. Woo. The Financial Insights Show. Tune in right, let the good times roll.
If you're an advisor, don't bring up gold, silver, or crypto. Wait for your client to bring them up. Okay? It does you no favors. Be proactive in positive ways. Don't be proactive in negative ways. By bringing light to a situation that they may or may not be aware of is a mistake. If your client brings it up, address it.
Liam, good to see you again, my man.
Good to see you, Mr. Ludwig. How you doing?
Doing good. You wrote a LinkedIn post too where you called me Mr. and I corrected you. It's Dr. Ludwig.
Professor.
That's right, yeah. Oh man, I'm just giving you a hard time. So we got the Olympics are kicking off tonight. Do you have any go-to events that you're excited about?
I had absolutely no idea that was happening. Where it's the Winter Olympics. I think I can glean that much. Where are they? They're not in the United States.
No, I think they're in Milan, Italy.
Okay.
Yeah.
Interesting. No, I have no predictions. I don't even know the events. I mean, I stopped watching when Shaun White stopped snowboarding. I think that those were my glory days. What about you? Are you a fan?
That's fair. Yeah, no, that's fair. I think the story that's been interesting to me is to watch Lindsey Vonn. She was like 41 years old, made this big comeback. Everyone kind of like wrote her off as like, oh, she's done with the sport. Made this big comeback. She got injured about a week ago. I guess she tore her ACL, but she did like a training run today, and she's planning to compete. So I've been kind of interested in that story.
Okay. Yeah. I don't follow it. Do you get out do you have a mountain near you where you ski?
Well, in Wisconsin, I don't know if I would call it a mountain, but we do have a ski hill.
Okay, it's a hill. Yeah.
I think most of our winter is tied up with basketball, but that just ended. So I'm hoping to get out a couple times.
Okay. Cause I hear from my folks in Utah and they have not stopped complaining about the snowfall this year. Or the lack thereof. There has been no precipitation that has stuck. And so all of the resorts are taking it right now. They're having a tough year. So if you ski like myself very infrequently and you don't know the difference between great powder and just, what I grew up with, which is where near you, a Michigan snow hill, might be a great time to go to a Utah and like a Vail or a Park City, because there's a bunch of deals because no one from the state is actually going. So that's a little inside baseball for you. I might have to venture out there soon.
I love it. Yeah. Oh man, that's cool. Are you a skier or a snowboarder?
Neither. Just a deal hunter. Just looking for a good deal.
Oh, I love it. That's awesome. Oh man. Well, I know I've been following you too. I know you've been on the road a bit lately. What was the recent event that you were at?
Yeah, we've been everywhere. I was just at EstateCon, Wealth.com's first ever annual event. Well, I don't know if it's going to be annual, biannual, but I think it was their first ever event. They had some big announcements that they made during, which was exciting. They're getting into tax planning. They're traditionally an estate planning suite of products and features. I think that makes sense. And they also announced an integration, bi-directional integration with Jump, and I think a few others. So they'll show up within our product. I spoke on conversational intelligence and had some good audience engagement. Derek Kinney was in the audience, who's a presenting hero of mine, somebody I look up to. When I think of who are the great presenters of wealth right now, he always comes to mind. And I also met, not at my presentation, but at lunch, I sat adjacently, not next to, but adjacently to Josh Brown and Michael Batnick, and I went up to them both after, interrupted their lunch. It looked pleasant, before I stepped in. I just told them they were my heroes, basically. And Josh looked at me and he said my name. He's like, "Oh, Liam," like almost like he knew me. And I was like, "Oh my God, he knows me." And then I looked down as I was walking away and I noticed I had a name tag on from the event. So he didn't know me, but it was still a good interaction. And yeah, it was a fun event overall. It was in Scottsdale, and so it's hard to complain about being in Scottsdale in late January.
Yeah, no, I saw the LinkedIn post afterwards. It seemed like it was fruitful for all of the people that were there, and that's pretty cool. Yeah, I've not seen. I was at FPA National last year, and Batnick was there, but we were like, he was coming in, and I was leaving, so I
Okay.
didn't get a chance to bother him in the men's bathroom or in the men's room or anything like that. So
Yeah. Yeah, I mean, those guys are they're great speakers, and they're always just on the nose on, like, interesting content. They seem like they're always ahead of the curve, so, I didn't get a chance to see their presentation. It was the day after mine, and I had left, but I'm sure it was great.
I'm
Where have
sure.
you been? What have you been up to?
Yeah, I've been like hibernating. I just feel like I've been working away. I got my first speaking event will be at a FPA of Upper New York, I believe. It's in Albany mid-March. So I'm a little bit nervous because the day after that I'm supposed to go on spring break with my family, and I'm a
Yeah.
little nervous about winter weather and making sure that the flights work out. But yeah, gearing up for that. And actually, it'll be one of the presentations. I'm going to do two while I'm there. One of them will be on this conversation intelligence stuff. So I'm excited
Okay,
to do that.
great. Yeah, we'll be at an FPA event together a few times this year, right? I think one in La Jolla.
Yeah, yep, the FPA Shift, which is the previously named, there was the FPA Retreat,
Yes.
and so I was there a couple of years ago. It's actually where I think it was at that event that I might have met, your CEO, Parker.
Okay.
I think it was actually at that event, yeah, so it's be kinda cool now for us to go
All
back.
all the event names are so funny. Shift. I'm going to Nitrogen Fearless next week. EstateCon. I'm sure they'll have a different name in the coming years, but there's a whole business in PR and branding around your event name.
Right, yeah, I agree, yeah, there's a whole company around that. Well, let's get into it. There's so much stuff going on in the news today. I thought the professor and me kind of wanted to start with a pop quiz, so I thought I'd run this by you, Liam, and then you can give me your best guess, and then either way, it'll give us something to talk about here. Is that fair?
Yeah, let's do it.
All right, here we go. And you can't use ChatGPT, you can't Google it. This is all
Hands
right.
off.
Okay. So, all right. Historically, the question is, which asset has shown the highest correlation with Bitcoin during major drawdowns? I'll give you three different options. Is it gold, tech stocks, or long-term US bonds? So highest correlation with Bitcoin during a drawdown, gold, tech stocks, or long-term US bonds?
I would have to imagine it's tech stocks. Only because long-term US bonds, I don't know a lot about, but they're just not that volatile. So I wouldn't imagine the correlation could be that strong. It just doesn't the market doesn't move as quickly. And gold and silver, I mean, just gold in general, I mean, all I know about it is that it went down for a long time and now it's been going up for a long time. And that's not the movement of crypto or Bitcoin. How'd I do?
Yeah, no, that is the correct answer. Yeah, oddly enough. I say oddly enough, I like that you picked up on the fact that it really has been more of this speculative asset, right? Which is interesting to me because I remember first starting hearing about Bitcoin kind of shortly after kind of like the early 2010s,
Right.
right? And it was, from what I remember, the early days of Bitcoin, it was meant to be this alternative to the banking system, right? That was the story being told. 2008 global financial crisis, people were really worried about the banking system. It was supposed to be kind of this hedge against the dollar. It was supposed, like, people were calling it digital gold,
Yes.
right? And so it was supposed to be this like at least from what I remember reading in the news at that time, it was supposed to be this hedge against inflation or volatility in the markets. What we've really seen is this transition to sort of retail investors picking it up, and then in the last couple of years, institutional, right, has been we start to see ETFs and all sorts of goofy stuff there. So it's been interesting. And then you can kind of look at it historically. Even we go back to the COVID volatility from March 2020. That was sort of the first stress test, I feel like, with Bitcoin. All these large, kind of large cap and tech stocks went down during that time, as did as did Bitcoin. So it's definitely been a speculative asset. I just like bringing it up because I think the for me, the takeaway for advisors, if they're using it in their portfolio, is that they should really ask, like, why do they own it, or why does their client own it? What role is it supposed to play in the portfolio? And I think as long as they think of it as a speculative asset,
Mm-hmm.
that kind of makes sense. If they're thinking of it in terms of this currency hedge or digital gold, as we were sort of sold on, that's where I would think some conversations around that would be helpful.
Yeah, it's been interesting to see this latest crypto mania up and down of volatility. The only part that's different than in the past, because crypto's been around for a while now, it goes through these cycles, right? Where as major gains, euphoria sets in, and then major losses. It's pretty predictable, or it seems to be, right? The subreddits or the forums of the anonymous internet would say that it's very predictable. What's different this time is what you mentioned, which is the institutional investment. There's a limited supply of Bitcoin, right? And so demand really, as we go further and further, by I think 2030, like 99% of all Bitcoin will have been created by that point of time. And so the question is, like, is demand by that point going to be greater or equal to what it is today? What's most interesting to me, the latest story is, I forget which country, but their currency collapsed. And a lot of people are holding Bitcoin now in countries where the currency is unstable against the US dollar because it's a better store of value. So it's serving the purpose that you said that you believed based on news early in its days that it would serve. It's just not serving that purpose for Americans. It's serving that purpose for Iran and for Turkey or Egypt, like currencies that are extremely volatile and can lose all of their value within a day. So, anyway, it's interesting. It's changed a lot when we look at crypto and assess demand, especially from the perspective of an advisor and a client. We're not thinking about the utility as much as we are thinking about just missing out or exposing ourselves to huge risk. Whenever it's going up, clients start asking about why they're not involved, and whenever it's going down, they start saying, why are we involved? So it's an interesting dynamic.
I love that. I used to say for years that whenever the market was up, it was because of a client's decision. Like they said, like, yeah, I wanted to buy that. And whenever the market was down, it was me. It was my fault. It was the advisor's fault.
Right. Yeah, everybody's a genius in a bull market. It's actually based on our research, we see during bull markets, that's when clients or prospects, I should say, really start saying to their potential advisors during prospecting calls, I don't see why I can't do this myself. Volatility in the market is, I think, an advisor's worst enemy when it comes to their current book of business, but their greatest gift when it comes to prospecting, because it opens up the door to talk about the value of your services. Like, what we're living through right now, this fear and volatility and the market swings, that's why my services are valuable for these times specifically. It allows you to just frame it in a more tangible perspective.
Yeah, I totally agree. The other thing too that I would say is I feel like for the financial advisor that has more specialty training outside of, say, investment management,
Mm.
like if it's retirement income or something like that, I feel like this is also the time that those types of specialists really shine, because you can look at, like, if the reason that they're calling, like you mentioned, is there's fear in the market. But a really good advisor can say, "Hey, look, this is actually a great time to do some Roth conversions." Well, how does that work? Oh, right. Like all of a sudden you can talk about different opportunities that are because of the volatility. I feel like that's really an awesome opportunity to shine, right? Like instead of just being the investment manager, because nobody really has control over what's going on in the markets.
Yeah, I agree. It was interesting too when we did our research for Jump, the annual insight report. We looked at different time periods and the fear of market volatility, and that would cause conversations to end with negative sentiment. Right? We measure sentiment at the beginning of calls, at the end of calls. So if it goes down, that's a conversation that's ended negatively. And four assets do better when you have negative sentiment from the perspective of an advisor making a recommendation. They convert more clients to accept those recommendations during those times of extreme volatility. It's commodities, alts, crypto, and insurance. So it's
Mm.
these. I guess we would need to do further research into what's causing that volatility, but crypto does better when clients are upset. And maybe it's because of that fear of missing out, right? That they've missed out on some opportunity because God knows crypto's been down. I think it's 50% since October. It'll
Yeah, I
be up
was looking
another
at that.
50%, in the next 3 months. That's the way this one works. But yeah, what are the stats around crypto?
Yeah, so we're recording this just for reference, February 6th. Uh, Today, as we're recording this, is Jump. It's up 6% for the day,
Right.
but it did hit its market peak. It looks like October 5th, somewhere in there of
Mhm.
2025 at about 125-ish, 125,000, I should say, and currently trading at around 70,000. So yeah, to your point, it's like a 50% cut roughly. And it was just down at 60,000. The other thing that I've been seeing making the news is that if you look at these charts, it really shot off. And here, maybe I'll just show this real quick of what I'm looking at.
Yeah, when did it start spiking or start declining?
So what's interesting is you see if we pull back a bit. So here is the peak kind of in early October of 25. If we peel
Remember.
this back a bit, going back to election time, and again, this isn't meant to be political, but shortly after Trump got in office, that's when we saw this huge jump.
Right.
And then now I think what's been kind of interesting, what's sort of made the news a bit is that it has now basically retreated back to the same price it was at the beginning. And I don't know, I hate to get all conspiracy theory, but some people are saying that that's intentional to put pressure back on the administration to do X, Y, and Z. The president seems to respond to market prices better than poll numbers. So I don't know if there's anything to that, but it's an interesting theory.
It's interesting that where we get our news is predicated based usually or can be predicted based on your age. I'm 30 years old. I'll be, coming up on my half birthday here soon. So I'm a flat 30 and I get a lot of my market news from Reddit. Used to be from Twitter, which I had to delete just because of doom scrolling. But Reddit suggests that this is the cycle of crypto, and that every time we have a down cycle, there are all these conspiracy theories, right? And it will last 4 years. That's what Reddit says. I don't know why. I don't understand it. I don't even try to, because I think most of it's just made up. I think it's lunacy. I think there'll be a time when crypto doesn't follow the same cycle, but apparently it goes up and then it gets crushed for 4 years and then it goes up. They think it's going to be $1 million by 2030.
Mm.
These anonymous geniuses of Reddit.
Boy. Yeah, I do have some concerns, and we've done some other research on where people get their information, their financial information sources from. And for sure, you do see an age effect for social media is obviously more dominant for younger individuals. But we've also seen like for more people that are starting to use ChatGPT and other AI sources, that seems to be a supplement to a professional advisor, which at least makes me feel a little bit better about that. That at least it's like a checks and balances because right, nobody really gets their information from a source, a single source. It tends to be this. But then it does make him wonder, though, what dominates the final decision making. Is it the friend? Is it that your neighbor said something? I don't know.
So I'm going to throw it back on you with a little quiz of my own. We talk about this quite a bit, and it almost feels like everybody's talking about it. What I would ask you is, of the advisor and client conversations that have happened in December, January, let's just talk about the first week of February. So in the
Okay.
last week, advisors and clients, millions of them have met. How many do you think are talking about gold and silver or crypto? And I'll give you a hint that about 60 to 70% of all advisors and clients talk about US equities during conversation. So assets come up. These are client review meetings. What percent of those client review meetings in the last week talked about gold and silver and crypto separately?
Gosh, I'm trying to think of this almost from like an allocation weighting. Like, what is the average allocation weight? Then maybe that would mirror the times it's came up.
It's all,
I
and
don't know.
it's
Go ahead.
any conversation. This counts, right? We're not having a meaningful conversation, but we brought up gold and silver. We brought up crypto. That would count as a percent.
Okay.
Yep.
So, and you said equities is about 60% on
60
average?
to 70 on average, depending on the month of the year. It's cyclical. It moves with the market as well, but it's high. It's always above 50%.
Okay. Well, I would think because of the recent volatility, I'm going to guess higher, right? I'll say at least, I'm going to say 50%. If I got to pick a number, I'll go with 50.
All right. Let's see what the answer is. Hold on. Okay. So per jump data, about 12.8% of advisors and clients in February discussed gold and silver, and about 9.3 discussed crypto. Now, that 9.3 for crypto is up, right? 2%. Relative to where it was, it's up, over 20%, close to 30%, 25%, I would say, gain in the last 2 months. And gold spiked in January of 2026. So last month, because we saw that huge, you were texting me about it, it spiked, it dropped 20%. Now it's kind of back up. So it's being talked about a little less. But this shocked me because I thought the same thing that you thought, which is 50% of people are probably talking about it. But the truth is, not that many clients are talking about it, which is why I brought up where we get our news. Like, I see crypto and gold talked about every single day, but the average client of an advisor, which is about 60 years old, and unless they're dialed in to the news, to CNBC, they're not getting exposed to these conversations. That kind of brings me to my next question, which is, okay, 10% of people talk about crypto, about 13% are talking about gold and silver. I told you it's about 60 to 70% talk about equities. What percentage of the, let's just say, crypto conversations do you think are inspired by clients, initiated by a client?
Ooh, yeah. So, like, who's bringing it up? And this is like in the recent or just kind of in the aggregate over the last
In February, in the first week
in
of February.
February?
Well, you know what? Let's do December, January, February all together.
Okay, so these last couple
Yeah, the
months
last
here.
3 months, as volatility
Who's
has increased.
I mean, gosh. My default answer is that it'd be the client themselves are the ones that are coming in asking about it. I don't know
You would
what is
be
the results?
you'd be right that clients are bringing up these alternative assets more than US equities. So if you see, US equities are brought up by the advisor about 88% of the time. I call those like the clock in, clock out assets. If you look at US equities, bonds, fixed income, uh, traditional equities, traditional asset classes, advisors are almost always the ones bringing them up because they're boring, but it's like the necessary part of the job, right? We got to talk about your allocation. That's why we're on the phone. Clients bring up a much larger proportion of crypto, gold, and or silver, right? About 45% of gold and silver conversations in the last 3 months have been inspired by clients. A major difference still about a 50-50 split. And by the way, we don't see any asset class being brought up by clients more than 45%. It's almost always the advisor initiating discussions about asset classes.
That makes sense. That does make me think too about when is the right time to talk about different asset classes, right? Like if you like we were just kind of looking at Bitcoin, but gold and silver are not that dissimilar in terms of their price charts, how they've really zoomed up and then taken a hit. And often wonder, like even last year in 2025, April, there was a tariff news that came out, and I feel like so the market was down early, and it felt like a lot of advisors
Mm,
were reaching out to their clients, telling them, "Hey, it's going to be okay. It's going to be okay." And they were like, "What are you talking about? I didn't even know that anything wasn't okay."
right.
Right? And it kind of makes me. You can almost see it here. It's like it's actually the advisor that is bringing it up, these issues, more than maybe it is. Which is, I don't know. Maybe that's good, but they're trying to get ahead of the curve. But it does make me wonder
You know,
uh, if it's
I
the
ha-
right thing.
I did some research on that. I know I'm blowing through this, but so I looked at last year, artificial intelligence, the one big beautiful bill, tariffs, interest rates, layoffs, US election. And what I wanted to see was exactly what you just said, which was, well, what's the impact on client sentiment if a client brings it up versus an advisor? The advisor bringing it up is represented in the lighter blue. The client bringing it up is represented in the darker blue. What you're seeing here is the average change in client sentiment from the beginning to the end of the call. So let me help you read the first column here, artificial intelligence. So if a client brings up artificial intelligence, right, they initiate this discussion, their average change in sentiment is from the beginning to the end of the call of those calls where they initiated a discussion about artificial intelligence, it's about 1.15. If the advisor brings up artificial intelligence during a conversation, the average change in sentiment is about 0.98, so much lower. So, meaning you see the light blue is lower than the dark blue in every instance. This means that advisors initiating discussions about these macro topics has a negative impact on client sentiment. So, your point is exactly right. I think sometimes as advisors, we think being proactive and bringing up these things is a good idea. The research would suggest it is the opposite of a good idea, that on average, you are reducing client sentiment over the course of a call. From beginning to end, you have a greater likelihood of it decreasing or just increasing less than if you just don't bring the topic up or wait for the client to bring the topic up.
This is fascinating, and I feel like it's like this type of research that you can't get from like our normal survey data type of stuff, right? Like it's because you're able to look at these conversations. This is fascinating. Wow.
Yeah, I really liked this one.
Well, one thing I'm just thinking about is that I've always thought that the right way that advisors should be talking about some of these things is sort of like dripping on them over time. Like it's
Mm,
almost this ongoing education piece that you're doing about like how the markets work and things like that. So that by the time something actually happens in the market, it's just kind of like what you showed, you're not really having to do it at that point. They've already been sort of trained to go like, "Hey, look, I already know the deal. I know markets are going cycles, right? Like my guy already told me, my gal already told me this is how things work. I'm not worried about it."
yeah, no, I agree. Um, so
So what are we
I
looking
looked.
at here?
Yeah, this is what I measured was, did the client state they had a fear related to a recession happening or market volatility? Just generally, my portfolio getting hurt due to market volatility. In January, we didn't see a spike in volatility talk, but we did see a huge spike in recession talk. And I think that was because of the ebbs and flows of the commodities market, gold and silver, of crypto. The asset markets wasn't going crazy, but it's been stagnant for the entire year. But in February, in the first week of February here, 50% of all conversations between an advisor and a client, the client has stated a fear of market volatility. So that's huge. If we go back to, I know I'm going to flip through slides here again and uh, give you a headache. looking at these. But if we look at last year, the greatest percentage of clients who had a fear of market losses or volatility, so the same prompt, was in March and April. Now, these are greater time periods, so it's smoothed out a little bit. There probably was a week within March and April where it could have hit 50%. So I'm not saying that market volatility now is more, that clients are more fearful right now than they were in March and April of last year, but you can just kind of see how this aligns with the market last year. March and April is really when the market crashed, but recession fears, represented in the light blue here, really rose and declined in complete parallel with market losses and volatility. You can see it also spiked in March and April, went down, and then started up again near the end of the year. So just interesting what's happening right now as we look back at this graph, that market volatility, the fear of market volatility is spiking. Recession fear is down right now. I think in the next 2 weeks, if these volatility concerns persist and the market continues to act in an abnormal way, this fear of recession is going to start peaking up. That's when client conversations get very difficult. If you have a fear of recession stated, your sentiment gets much, much lower, which is really the last thing I measured, the average starting client sentiment by date. And I'll jump into this in a second, but let me pause here, see if you have any questions about this.
Well, yeah. So I'm just thinking if this is actually like what you were showing on a bigger scale earlier, when we looked at it over like the course of sort of a year, this diversion never really happened, right? They were more highly correlated, which makes this that much more interesting, right? Is that there is a bigger spike rather in uh, market volatility, whereas fewer people are actually worried about the recession aspect. Is that what you're kind of saying?
Yes, exactly. And so my hypothesis is that the fear of recession will start spiking as well. It will join the fear of volatility and get back in parallel. We almost never see those two things diverge. They could lead or lag each other a little bit. So it looks like it's lagging the fear of market volatility, but it will, I think, start going up as these conversations evolve and continue into the next week of February.
Interesting. Yeah, definitely something to watch here. Oh my gosh. Okay.
And then if we look at the average client sentiment, the average client starting sentiment last year, so in 2025, was 6.44. This is a proprietary scale that we've created to measure client sentiment over a long period of time. So we measure it at the beginning, the middle, the end of calls. And the beginning of calls, starting sentiment 2025, 6.44 was the average. You can see each of these numbers is below the average and declining rapidly. In December, it was 6.36. In January, 6.13. In the first week of February, it's under 6, which we did not see once in all of 2025. The lowest it got in 2025 was about 6.2. So we are in new territory when it comes to client sentiments. They are more fearful right now than they were in all of 2025, even during tariff mania and everything else that transpired. Sentiment never got this bad.
That's interesting. And it seems like maybe, I mean, you and I were just talking about the type of news that we see, whether it's Reddit or Yahoo Finance or whatever, that's related to market news. But it almost makes me wonder if there's something, if this is maybe more geopolitically related. I mean, it's been hard actually to keep up on the news any given weekend of what's going on in the world. I don't know. What's your take on that? Do you think this is separate from market related, economic related things? And that's kind of shows up with the sort of lack of fear with recession.
I think that people are waiting for the other shoe to drop. We see all of this data that historically has pointed us towards a weak economic market, and yet that doesn't seem to be the case when you look at the S&P 500's return over the last 2 years, right? We're at all-time highs or very close to all-time highs. And so there is a fear, I think, among the general population that we're in this state of euphoria and that we can't go any higher without a pullback. And it exists in almost every single market right now, except for crypto. What's happening with crypto may be the writing on the wall for what's going to happen with these other asset classes. And maybe that's what's causing this fear or anxiety. Gold and silver at all-time highs. S&P 500's at an all-time high. Housing markets at an all-time high. And for retirees, the clients that are having these conversations, you do want all-time highs going into retirement, but you want that to persist throughout your retirement so that in year one, when you're transitioning into this new phase of life, you don't lose half of your assets because the market drops at a moment's notice. So I think that's what's causing it. This is a hypothesis. I don't have research to back this up, but I listen to, people like Aswath Damodaran, and he's kind of like the father of equity evaluation, if you will. And even he was suggesting recently to move money out of equity markets into alternative assets like real estate, like artwork, or even, collectibles. So it's an interesting time. I think unease is the general sentiment, though.
So let me ask you this then. With the data that you have, are these contrarian indicators or do they seem to actually line up? The common one that shows up is the AAII, what is it called? American Association of Individual Investors. They do a weekly survey. They just ask people, how are you feeling about the market? They can only answer one of three ways. It's either they're bullish, bearish, or neutral. And for the most part, whatever the weekly reading is just total noise.
Right.
Unless you get to extremes. When you see people are the most bullish, that almost always indicates market peak, and vice versa. When people are the most bearish, they're just like, the market's for sure going to keep going down. That's actually a turning point. So I'm just curious. So, and those are individual investors, right? It's just random, not random, but I mean, it's just people that log on. They're members of the association. They can vote. I'm curious of how that has lined up with what you've seen. It looks like you have some data to back this up.
There is conversations between advisors and clients can both be a leading and a lagging indicator in different markets. When it comes to the stock market, I've found it has absolutely no predictive ability. The strongest correlation that I found between conversations and movement is actually on a 1-month lag, not a 1-month lead, meaning, and this is Tesla, when Tesla's stock price declines greatly, the next month, conversations spike greatly. Okay, so if Tesla drops this month, conversations next month are going to increase. And if you think about it, that makes a little bit of sense because of the dynamic of an advisor and client conversation. You're kind of preparing to have that conversation. You don't just jump on the phone. Usually this is scheduled in advance. And so this ebbs and flows of the market in the month before are probably more meaningful than the ebbs and flows of the market the day of, right? It's leading up to the conversation. So the stock market, we find you cannot predict the movement of the stock market based on conversations, but you can predict conversations based on the movement of the stock market. Now,
man, I was hoping that we had a hedge fund opportunity here, but all right, keep going.
Conversely, you see, this is the exact opposite for the housing market, right? So housing market conversations do have a predictability on a 1-month lead. So this is if the client states, hey, if you're my advisor, Eric, I'm listing my house, okay? It's a done deal. We're going to put it on the market. What we see is a very tight correlation with housing inventory spiking in the next month, right? So increase of number of clients saying I'm listing leads to increase of inventory per Zillow data. This is pretty tight correlation. So the R squared of this model is 0.66, meaning the correlation itself is about 0.82. So very, very tight, meaning you can predict to a high certainty using just this data what housing market inventory will be in the next month based on conversations this month.
That's actually kind of insane. I mean, for just for people listening as a reference, if you're doing like social science research and you run a regression with several variables, a really good model, like a very good R squared, is like maybe 20%, which means that that set of variables that you have is explaining about 20% of whatever this outcome is that you're interested in. To have that high of a correlation or R squared for a single variable, that's pretty insane.
For a single variable. And when you combine this with, so this is just simply a client stated intent to list their home. Combine it with client stated intent to buy a home. And so if lists go up, buys go down, this becomes an even stronger relationship, right? Now you can really say, well, people are listing and they're not planning on buying. Inventory is going to skyrocket. No one's buying homes. Inventory only moves because people put homes on the market or they buy homes off the market. So, yeah, maybe this is our hedge fund opportunity.
I was going to say, if there's a jump hedge fund in a couple months, I'll know why.
Yeah. If you won't know. I won't say anything, but there will be signs, and it will be, I'll be in Cabo or something on a yacht.
Exactly. Yeah. Oh my gosh. Well, this has been fascinating. So what, like, if I'm an advisor listening to this, what are some different takeaways that you're thinking here? I mean, we've talked about certainly lots of market volatility going on with these different asset classes, especially Bitcoin, gold and silver. Are there takeaways that you're like, okay, based on everything that you're looking at from the conversational data, pairing that with what we're just seeing with price data, is there anything that comes to mind for you?
Yes. I think two main things. Number one, if you're an advisor, don't bring up gold, silver, or crypto. Wait for your client to bring them up. Okay? It does you no favors. You be proactive in positive ways. Don't be proactive in negative ways. By bringing light to a situation that they may or may not be aware of is a mistake. If your client brings it up, address it. But I would say that the research shows you hurt yourself when you bring up these topics that cause anxiety sometimes. Number two is we've entered into this phase of very low client sentiment. During times of low client sentiment, advisors do have a few strategies to improve sentiment and some things that they shouldn't do. Number one, the strategy that I would suggest employing is to spend more of your conversation on goals and planning. The best advisors, we call them the highest emotional intelligence advisors, spend almost 40% of meetings on goals and planning discussions, long-term goals and planning, and they see huge increases in client sentiment from the beginning to the end of their calls. So that's what I would suggest. And I would also suggest avoiding proposing or positioning new investments or reallocations until you have the goals and planning discussion, because clients with low sentiment are less likely to accept investment recommendations about annuities, equities, US equities, or international bonds, fixed incomes. Most of the core asset classes, clients would rather not engage with those discussions if their sentiment is low. So first, focus on getting sentiment up by focusing on goals and planning. Stay away from investments in markets. Goals and planning and behavioral coaching are great places to increase sentiment. And number two, don't propose a recommendation for an investment until the sentiment's up.
I love that. This is so practical. It's incredible data. I'm so glad that you're able to share everything today. And I think, if market volatility, if it keeps being a thing, I guess, as it seems to be, I'm sure next week or the following weeks, we'll find out more what's going on and be able to track these conversations. And this is great. Thank you so much, Liam.
Yeah, Professor. Until next time.
All right, until next time. And we'll know what the Olympic results are then, I guess.
Yeah, exactly. Lindsey Vonn. Go Lindsey Vonn.
Go Lindsey. All right. Thanks, Liam.